Welcome back to Gold Rush Reporter, your go-to channel for everything gold and silver. I'm your host, bringing you the latest insights as a specialist analyst, decoding the precious metals market so you can make sense of it all. Today, we're diving deep into the recent moves in silver and gold, and why they matter for both everyday investors and large institutions. Before we begin, don't forget to like, subscribe, and hit that notification bell. This is where you'll catch updates you won't get anywhere else. Recently, silver has been on a tear, breaking $50 and hovering around $53, while gold continues its steady climb, gaining roughly $100 per week. But what's driving these moves? A big part of it is the devaluation of major currencies. The dollar, euro, yen, pound, and even the yuan are being systematically weakened because governments can't pay off massive debts without inflating their currencies. This reality, though long theorized, is now becoming impossible to ignore. Central banks around the world are grabbing every ounce of gold they can find, signaling to markets that gold is a critical hedge. Ordinary investors are following suit, fueling further demand. Silver, on the other hand, plays a dual role. It's both an industrial metal and a medium of exchange linked closely to gold. If it were purely industrial, we'd already be facing shortages. But now its market is small, liquidity is low, and physical supply is dwindling, creating the perfect storm for a potential silver squeeze. The US government recently designated silver as an essential mineral. This means manufacturers of missiles, solar panels, and other critical technologies must keep silver on hand to meet growing demand. That alone encourages hoarding, as companies can't risk waiting until the last minute to secure supplies from the volatile spot market. For individual investors, this creates both opportunity and urgency. People are buying silver not just to use, but to hold, anticipating rising prices. Unlike gold, whose market is massive, silver's smaller market size means even modest increases in demand can trigger substantial price swings. This is why aiming for $100 per ounce in silver over the next couple of years is not unrealistic. When supply is constrained and industrial demand remains high, the upside potential is enormous. Think of it this way. A tiny market suddenly facing huge demand can skyrocket in value. When silver hits triple digits, it's time to think about taking profits. But don't sell everything. Historically, metals like silver have multiple parabolic runs over time. The key is positioning yourself now and holding through the volatility. In this environment, being early matters. Just like those who started stacking silver at $4 an ounce decades ago, long-term patience in precious metals has historically rewarded those who endure periods of stagnation. While Bitcoin and tech stocks have their bubbles and crashes, gold and silver continue to provide real, tangible wealth, unaffected by the same kind of speculative swings. Stay tuned, because in the next part, we'll break down the role of institutional investors, how commercial banks are influencing the market, and why understanding these forces can position you ahead of the curve in gold and silver investing. We discussed why silver and gold are surging and the role of currency devaluation. Now, let's dig into what's happening behind the scenes with big institutions and how their actions can shape the market for all of us. When silver hit $50, it wasn't just retail investors buying. Major American commercial banks like Morgan Stanley and Bank of America stepped in aggressively. These are institutions controlling trillions of dollars. Their actions aren't random. They're following strategies that can influence the entire market. For example, recent guidance from Bank of America suggested institutional investors should hold 20 to 25% of assets in gold. Morgan Stanley's chief investment officer even advised selling half of bonds to switch into gold. This is not a small-scale operation. It's the kind of move that signals to everyone that gold and silver are core assets, not speculative plays. Meanwhile, the COMEX and other exchanges experienced unusual activity. Large quantities of silver contracts are waiting for physical delivery, but supply is tightening. If even a single contract is settled in cash instead of metal, prices could skyrocket almost instantly. This is why positioning yourself now is crucial. You want to be ready for these sudden spikes, even if you can't predict the exact timing. Look at the market historically. Silver was around $4 an ounce in 1999, gold at $240. Those who stacked back then are now reaping enormous gains. Today, silver's price may seem high to some, but relative to gold, it's still a bargain for long-term investors. And unlike tech stocks or crypto, silver has industrial and monetary demand that ensures real-world value. Industrial demand for silver is also accelerating. It's essential in solar panels, electronics, and other critical technologies. Combined with its monetary role, the metal's importance cannot be overstated. This dual demand, alongside a relatively small market, means even modest buying pressure can drive dramatic price increases. It's why experts predict $100 per ounce is attainable in the coming years. Timing matters, but so does patience. Short-term traders may panic at corrections, but long-term stackers know that volatility is normal. The key is to endure price swings and stay positioned for the next upward move. Institutions are accumulating, governments are hoarding, and commercial banks are quietly buying physical metal at discounted prices during market dips. This isn't hype, it's strategy. Meanwhile, the broader market shows signs of instability. AI stocks, crypto, and other speculative assets are in bubbles. Michael Burry's recent hedge fund moves illustrate how difficult it is to bet against these trends, especially when billions of dollars are at stake. If major sectors like AI or tech experience sharp corrections, it could impact global markets. But precious metals remain a safe, tangible hedge. Gold and silver provide a form of protection when everything else becomes unpredictable. We looked at how major banks and institutions are quietly influencing gold and silver. Now, let's focus on the supply side, industrial demand, and why physical possession of these metals is becoming critical. Silver isn't just a precious metal, it's industrial. It's used in solar panels, electronics, batteries, medical devices, and even military applications like missiles. That industrial demand is growing rapidly, but supply isn't keeping up. Many of the big silver mines are nearing the end of their easily accessible deposits. Mining companies like First Majestic are still strong, but finding large, high-grade silver veins is becoming increasingly rare. Most silver mined today is a byproduct of other metals like gold, copper, and zinc. That's a big difference compared to gold, which is mined for its own sake. The US government has also designated silver as a critical mineral. That means industries must maintain a certain amount of silver in stock to meet production needs. Think about solar panels or military electronics. They can't wait for a spot market price to drop. This kind of government recognition increases hoarding by companies and individuals alike. More buyers are competing for the same limited supply, and that naturally drives prices up. Meanwhile, overseas buyers, especially China, are aggressively entering the silver market. Chinese companies are offering higher prices to miners than Western buyers. They are securing physical silver directly from mines, sometimes paying double the market rate. This is not a rumor, this is happening. They are building infrastructure, like deep water ports in Peru, to control the supply chain. When one country is willing to pay twice as much, it creates a floor under the price, because miners naturally sell to the highest bidder. At the same time, physical gold and silver are disappearing from exchanges like COMEX. Registered inventories, metal ready for delivery, are shrinking. Backwardation, where spot prices are higher than futures, is becoming common. This is a signal that physical stress is building in the market. If a single major futures contract defaults and is settled in cash instead of metal, prices could skyrocket. These are not abstract risks. They are very real and measurable. Retail investors often panic during short-term price corrections, but savvy stackers understand that physical scarcity is the ultimate driver of price. When paper markets are volatile, real metal always wins. Look at what happened in past market crashes. The 1980s and 1990s showed that when prices fell temporarily, buyers jumped in, and the bull run continued. History is repeating itself today. It's also important to note the psychological factor. Fear, more than greed, is now driving the market. People see governments devaluing currencies, inflation eroding savings, and stock markets behaving unpredictably. Gold and silver provide security. Unlike cryptocurrencies or stocks, these metals cannot be printed or devalued at will. Holding physical metal is becoming a survival strategy, not just an investment. Finally, think about the scale. The physical gold market globally is around $15 trillion, mostly sitting idle. Yet platforms like Monetary Metals are finding ways to put it to work, allowing investors to earn returns on leased gold and silver. This shows a shift in how gold is used. No longer just stored in vaults, it can generate income while still being tangible. So far, we've covered how central banks, institutions, and international buyers are quietly driving the precious metals market. Now, let's dive into what this means for retail investors and how you can strategically position yourself. First, understand that timing is everything in the metals market. Short-term fluctuations are normal. Prices can spike or drop dramatically, but the underlying fundamentals remain. Supply is limited, demand is increasing, and physical possession is becoming more critical. Unlike stocks or cryptocurrencies, gold and silver cannot be created out of thin air. When market sentiment shifts, physical metal always retains value. That's why having bullion in hand, whether coins or bars, is crucial. Silver, in particular, has enormous upside potential. Its small market size and heavy industrial use make it far more volatile than gold. When industrial demand spikes, or when futures contracts are settled in cash instead of physical metal, silver's price can shoot up quickly. In other words, you don't need every market move to make money. You need to be in the right position when the next surge occurs. Next, consider institutional behavior. Banks like Morgan Stanley and Bank of America aren't just participating in the paper market. They are aggressively acquiring physical gold and silver. They are following their own analysts' advice. Holding 20 to 25% of assets in gold is considered safe. These are trillion-dollar institutions, and their moves are a signal to retail investors that it's time to pay attention. When the same players who can move markets buy metal right after a sharp drop, it's a sign of strength, not weakness. Meanwhile, governments and central banks are stepping up their purchases. BRICS nations, especially China and Russia, are stockpiling gold and silver as a hedge against dollar dependency. They are building supply chains and controlling access to critical metals. This isn't speculation. It's a coordinated effort to secure resources for both economic and strategic reasons. As a retail investor, understanding where these metals are flowing helps you anticipate potential shortages and price surges. Retail traders often panic during sudden price drops. They sell out of fear, thinking the bull run is over. But history shows that these are precisely the moments when smart buyers accumulate. Silver, for example, has surged even after steep corrections because the underlying industrial and monetary demand remains strong. Fear creates opportunity if you are prepared and have patience. It's also worth noting the ongoing challenges with the US Mint. Coins like silver eagles and gold buffaloes are becoming increasingly difficult to acquire due to limited production and rising premiums. This reflects a broader trend. Physical scarcity is hitting retail markets, while institutional players quietly accumulate. Prices in the real world will reflect scarcity long before paper markets catch up. Finally, consider the big picture. The current market environment is complex, with bubbles forming in AI stocks, crypto, and other speculative assets. Precious metals, by contrast, offer a rare combination of security, tangible value, and upside potential. They are a hedge against currency devaluation, market volatility, and geopolitical risk. For retail investors who position themselves wisely, the next few years could be extremely profitable. We'll focus on practical strategies, risk management, and how to capitalize on the precious metals market as a retail investor. First, let's talk strategy. Gold and silver are not just investments. They are insurance against systemic risk. The goal is to acquire physical metal steadily and consistently. Avoid chasing short-term price movements. Instead, focus on accumulating over time, ensuring you have tangible assets when market disruptions occur. This approach allows you to take advantage of scarcity and industrial demand without falling prey to panic selling. Silver, in particular, offers exceptional upside because of its smaller market size and heavy industrial use. A sudden supply shortage, whether due to futures contracts being settled in cash or unexpected industrial demand, can trigger parabolic price movements. If you are positioned correctly, these movements can dramatically increase the value of your holdings. Gold is less volatile, but provides unmatched stability and liquidity, making it the backbone of any serious metals portfolio. Next, consider institutional and global behavior. Banks and hedge funds, along with BRICS nations, are quietly acquiring massive quantities of gold and silver. They understand the long-term value and are strategically securing supplies. Retail investors often underestimate this factor. Observing where institutions place their bets helps you anticipate market trends and act before prices reflect scarcity. When these players buy after a market drop, it signals opportunity, not weakness. Timing and patience are critical. Major market corrections can appear alarming, but history shows they often precede significant gains. Fear-driven selling by smaller investors creates opportunities for disciplined buyers. Understanding that volatility is a natural part of these markets will help you maintain perspective and act rationally rather than emotionally. Avoid overreacting to headlines or media-driven panic. These are usually designed to manipulate sentiment. Physical scarcity is another essential factor. Coins like silver eagles and gold buffaloes are increasingly hard to obtain. Rising premiums and limited availability highlight the real-world shortage that institutional players exploit. Retail investors who plan ahead and purchase steadily will benefit as scarcity pushes prices higher. Remember, having physical possession of metal is far more secure than relying on paper assets or ETFs. Finally, risk management. Never over-leverage and always diversify within your metals portfolio. Gold for stability, silver for potential exponential gains. Monitor global trends, supply constraints, and central bank activity. Stay informed about industrial demand and geopolitical shifts, as these will directly influence prices. By positioning yourself wisely, you can protect your wealth and maximize returns over the long term. In conclusion, the gold and silver markets are entering a critical phase. Institutions and nations are quietly accumulating. Retail markets are beginning to feel scarcity, and industrial demand is rising. Patience, strategic accumulation, and awareness of market dynamics are your keys to success. Stay calm, stay informed, and focus on physical possession. The next few years may reward disciplined stackers more than any other asset class. If you found this valuable, make sure to subscribe to Gold Rush Reporter, hit the like button, and stay updated on the latest insights in gold and silver. Your support helps us continue bringing expert analysis to the community.